I want to start today by asking you a question.
A question about the things that actually keep you awake at night. Right now, today, on Thursday, June 18th, 2026.
Yeah. Why are millennials getting poorer?
Right.
Why does artificial intelligence feel like it might just, completely wipe out the middle class?
Exactly.
And why does the United States economy sometimes feel like it's operating in the very late stages of an empire?
It's a heavy feeling, but it leads to perhaps the most important historical question of all.
Which is?
Why did Japan lose 30 years?
Right. The famous lost decades.
Yeah.
If you ask anyone on the street, or even most people in finance, they think they know the answer.
You probably think you know the answer too.
The standard narrative is so simple, it was insane greed.
Pure mass hysteria.
Right. A century-defining bubble of just unadulterated irrationality. You picture businessmen buying up golf courses in Hawaii.
Lighting cigars with $100 bills.
Exactly. It's a very comforting story.
It is. We love that story because, well, it puts all the blame on human character.
Right. It lets us point at the history books and say, look at those fools.
We would never be that stupid.
But what if that story is a complete lie?
What if the real horror wasn't greed at all?
Welcome to the deep dive. We're looking at a paper today that just shatters that comforting narrative.
It's by Robert B. Barsky from the National Bureau of Economic Research.
And the title is The Japanese Bubble, a Heterogeneous Approach.
And what Barsky does here is, well, it's terrifying.
It really is.
He doesn't use the benefit of hindsight to just mock the investors of the 1980s.
No, he doesn't. He looks at the exact data they had sitting on their desks.
He looks at the cold, hard math.
And he proves that the Japanese bubble wasn't a failure of character.
Not at all. It was a fatal collision. A terrifying mismatch between how the human brain naturally processes information and how our financial markets are mechanically designed.
I read this paper, and I have to admit, it completely broke my mental model of how financial markets actually work. Because usually when we analyze a crash, we look for the villains. We look for the fraud.
Right, the bad guys.
But Barsky points out that the villains weren't necessarily people.
The villain was the math.
Yes, and the architecture of the market itself.
Precisely. Barsky takes this cold data to decode the hidden underlying logic of how world assets actually operate.
And what he finds is just, it's an operating code for financial disaster.
A code that can be replicated anywhere, at any time.
So pull up a chair. You are sitting at the table with us today.
We are going to decode this entire disaster.
And we're going to do it without a single piece of Wall Street jargon. When we hit a complex math model, we're going to break it apart.
Too, because you need to understand this.
Right. This isn't just a Japanese tragedy from the 80s. This is the fundamental blueprint for how wealth gets vaporized.
Let's set the scene. I want you to visualize a pure white graph.
Just a blank canvas in your mind.
Draw an x-axis at the bottom. Start the timeline at 1985.
And end it at 1990. Just 5 years.
Now, we are going to track two things on this graph.
The Nikkei stock index.
Right. Yeah, the broad measure of the Japanese stock market. And urban land prices in Japan's top 6 cities.
Draw the line. Starting in 1985, the line doesn't just climb. It doesn't, trend upward gently.
It goes completely vertical.
The line for the stock market and the line for real estate just overlap almost perfectly, rocketing toward the top of your mental canvas.
Now take a heavy red marker.
Okay.
Draw a massive circle around the peak of that line.
Yeah.
Right around the very end of 1989.
Inside that circle is a staggering reality.
A threefold increase.
3 times the wealth.
Created entirely out of thin air in just half a decade.
Let that sink in for a second. If you own a home worth $300,000 in 1985,
it was worth nearly $1 million by 1990.
If you had $100,000 in the stock market, you suddenly had $300,000.
And this is where every history textbook steps in and laughs.
Right. The historians write that the Japanese were completely out of their minds.
A fever took over the nation.
But here is the first major slap in the face from Barsky's data.
What if they weren't crazy at all?
How?
What if, based strictly on the fundamental macroeconomic numbers sitting right in front of them in 1985 and 1986,
yeah,
their actions were flawlessly rational?
Okay, hold on. I have to push back on this immediately. Flawlessly rational.
Yes.
To buy Tokyo real estate at prices that literally defied gravity. To buy stocks that were trading at 50, 60, 70 times their earnings.
I know how it sounds.
You cannot look me in the eye and call that rational.
I can. And the data backs it up completely.
Oh.
You have to remove your 2026 hindsight. You have to put yourself in a trading room in Tokyo in 1986.
Okay, I'm there.
Look at what was happening in the real economy at that exact moment. Two massive tectonic shifts occurred simultaneously.
What was the first one?
First, the cost of borrowing money violently dropped.
The violently drop. Because, I mean, interest rates move all the time. 0.25% here, 0.5% there.
The Bank of Japan aggressively slashed rates. Long-term real interest rates, the actual cost of debt after you account for inflation.
Right.
They plunged by a massive 120 basis points in a very short window.
So the floor just fell out from under the cost of money?
Exactly. Suddenly, money is incredibly cheap.
Yeah.
The banks are practically begging you to take their capital.
That is shift number one.
Now, look at shift number two.
Mm-hmm.
At the exact same moment, that money became virtually free.
Yeah.
The actual underlying economy of Japan was roaring. GDP growth spiked.
And corporate cash payouts, dividends, they were growing at an unprecedented rate too, right?
Yes, unprecedented.
So let's translate this to everyday logic for you listening. Let's say you are running a mid-sized manufacturing business in Tokyo.
Okay.
The bank manager calls you up and says, hey, we will lend you 1 billion yen at practically no interest. That's a rate drop.
Right.
Then you look at your factory floor.
Yeah.
You are producing goods faster than ever, selling them globally.
Your profit margins are expanding wildly.
Your business is spitting out cash twice as fast as it was just a few years ago. That's the growth spike.
That is the exact macroeconomic reality of 1986.
So if you are looking at those two flawless, beautiful numbers,
Cheap money and skyrocketing growth.
why wouldn't you believe that the rules of the game had fundamentally changed?
You absolutely would believe it. You would look at the data and conclude that Japan had unlocked a permanent new economy.
An era of endless structural prosperity.
You wouldn't be hallucinating. You would just be following the data.
The data literally told you to buy everything you could get your hands on.
And this is where the systemic illusion begins.
Okay, let's unpack this.
The bubble wasn't a mass psychosis born out of thin air. It was a logical conclusion built on a foundation of completely real, extremely positive data points.
But the data was a trap.
It was the deadliest trap imaginable in finance.
Why?
Because those positive data points activated the math. And the math, under those specific conditions, becomes a weapon of mass destruction.
Okay, let's get into the math. Because I know when people hear valuation formulas, their eyes just glaze over.
I know, but stick with us.
You pointed out something in Barsky's paper that is utterly fascinating.
The deadliest crises don't hide in the fireworks.
They hide in the most boring, microscopic places.
Look at the year 1982. This is way before the bubble party started. Nobody was buying Rolexes and popping champagne in 1982.
But the trap was already fully set.
In 1982, the cash payout from Japanese stocks, what we call the dividend yield, was already incredibly low by global standards.
It was hovering around 1.5%.
By 1985, it fell to 0.88%.
Less than 1%. That means if I invest $100, the company is paying me back less than $1 a year in cash.
Exactly. And at the absolute peak of the madness in 1989,
What did it hit?
the yield hit a microscopic 0.5%.
Half of 1%.
Yes,
Stop right there. Half of 1% sounds incredibly boring. It sounds like a rounding error.
it does.
Why does a tiny, boring number cause a historical catastrophe?
To understand that, we have to look at the engine under the hood of the stock market.
How professional investors actually calculate the value of an asset.
The gold standard for this is a formula, but we don't need the academic name. We just need to understand the fragile math of tiny numbers.
Okay, break it down for us.
It is actually very simple arithmetic. It takes the cash dividend a company pays you and divides it by a specific number.
And what is that number?
That number is your required rate of return minus the expected growth rate of the company.
Okay, so value equals dividend divided by the difference between return and growth.
Correct. Let's run a normal scenario. Let's say you require a 10% return on your money to take on the risk of buying a stock.
It's okay.
And let's say you expect the company to grow at 5% a year,
So I take my 10% requirement minus the 5% growth.
which leaves you with 5%.
Exactly, or 0.05.
Exactly. So if the company pays a $1 dividend, you divide 1 by 0.05.
The formula tells you the stock is worth $20.
Simple. Stable.
Very stable. Because the gap between your required return and the growth rate is why. It's a full 5% gap.
Right. If the company announces slightly better growth, say 6% instead of 5%, the math shifts a little bit and the stock price goes up a little bit.
The wide gap acts as a shock absorber.
A shock absorber, I like that. It keeps the car from flying off the road when you hit a bump.
But what happens when that baseline yield falls to practically zero?
What happens when it hits 0.5%, like it did in Japan?
It means the shock absorber is completely gone.
Explain the math on that. Why is the shock absorber gone?
Because for the yield to be 0.5%, your required rate of return must be practically identical to the expected growth rate.
The gap between them is no longer 5%. It is razor thin. It is 0.5%.
So using the formula, I am dividing my dividend by 0.005.
Yes. And here is the terrifying magic of that math.
Yeah.
The formula becomes a loaded spring.
A loaded spring. Let me try an analogy here for you listening.
Go for it.
Imagine you are trying to balance a heavy bowling ball on the absolute tip of a sewing needle.
That is what the Japanese economy was in 1986. A bowling ball balanced on a needle.
That is exactly right. Because the gap is so razor thin, the math breaks down.
Or rather, it explodes upward.
Think about the denominator in that fraction, the gap between return and growth.
If the economy surges and investors revise their expected growth rate upward by just 0.5%,
Then the growth rate equals the required return rate.
the denominator becomes zero.
And what happens when you divide a number by zero in mathematics?
It pushes the result to infinity.
Infinity.
It's not poetry. It's not a metaphor. It is the literal mathematical output of the formula. When the gap approaches zero, the valuation approaches infinity.
This is mind-blowing. So when the Bank of Japan dropped interest rates and the economy surged?
The investors in Tokyo weren't just randomly bidding up prices because they were greedy.
No. They were plugging real, highly positive economic data into standard, globally accepted mathematical formulas.
And because the starting yield was already practically zero, the formulas literally told them the assets were worth a fortune.
The math gave them permission to buy at any price.
It did.
But wait, I have to call a timeout here. You are talking about institutional investors, professionals, the smartest guys in the room.
Yes.
Surely someone looked at this math and realized it was a trap. Surely someone saw the bowling ball wobbling on the needle and said, this is absurd.
Right. The margin of safety is zero.
Exactly. If growth slows down by even a fraction of a percent, the denominator widens and the price will collapse.
You are absolutely correct. Many people saw the flaw. They saw the trap.
So why didn't they stop it?
Because of the splintered world. Because of a violently divided world.
A market where people completely disagree on reality.
Exactly. Faced with this insane exponential growth driven by fragile math, the world didn't uniformly agree. It split right down the middle.
Picture a massive trading floor in your head. Let's physically split it in half.
On the left side of the room, you have the optimists. These are the believers.
They have giant light bulbs over their heads.
They look at the cheap money, they look at the surging GDP, and they preach the gospel of the new economy.
They plug the numbers into their models and they buy.
And on the right side of the room, you have the pessimists. These are the skeptics.
They are looking at the exact same data.
But their conclusion is totally different. They see the bowling ball on the needle.
They are absolutely convinced this is a temporary fever, a statistical fluke that will inevitably revert to the mean.
They know it's going to crash.
So we have two groups with violently different realities. How is a financial market supposed to handle this disagreement?
Well, if we connect this to the bigger picture, in a normal functioning capitalist system, they fight it out.
They fight with their wallets.
Precisely. The optimists take their cash and they buy shares, which pushes the price up.
And the pessimists take their capital and they sell shares. Or if they don't own the shares, they bet against the market.
Their actions push the price down.
It's a massive, chaotic tug of war.
And the red flag right in the middle of the rope, the true price, eventually settles somewhere in the middle of their disagreement.
It is forged in the fire of their debate.
That is how a market is designed to operate. It aggregates all information, both positive and negative, into a single price.
But in Japan, in the late 1980s...
the rules of the arena were secretly rigged.
This is the part of Barsky's paper that actually makes my stomach turn.
It's dark.
Because when you look at the smoking crater of the Japanese economy in 1991, you have to ask, where were the brakes?
Right.
Why didn't the pessimists on the right side of the room pull the rope and stop the runaway train?
The brakes were systematically disabled by the financial regulators themselves.
Wow.
Let me reveal the dark truth of Japan's market rules during the bubble. The skeptics, the pessimists who knew the math was a trap, they had their mouths taped shut by the government.
Taped shut. Financially gag. Explain exactly how you gag an investor.
Through brutal systemic restrictions on short selling.
Okay, let's break down short selling for anyone who doesn't trade every day, because this is the linchpin of the whole disaster.
It is.
In a normal market, if I think a stock is garbage and it's trading at $100, I can borrow a share from someone else.
And you sell that borrowed share immediately for $100 cash.
Then I wait. When the company inevitably reports terrible earnings, the stock price drops to $50.
You take $50 out of your pocket, buy the share back from the market, and return it to the person you borrowed it from.
I just made a $50 profit because I correctly identified a bad asset.
That is standard short selling. It's the
Yeah.
financial mechanism that allows skeptics to exert downward pressure on a price.
It is how you pop a bubble before it gets too big.
But in Japan, the regulators viewed short selling with extreme suspicion.
They saw it as unseemly or disruptive to harmony.
So they banned naked shorting completely. Naked shorting is when you sell a claim on a stock without even borrowing the underlying share first.
Banned. Illegal.
Completely.
Okay, but what about standard shorting? Could I borrow the share and short it?
Even standard shorting was strangled by a bureaucratic nightmare of rules. They enforced strict uptick rules.
What is an uptick rule?
It means you are legally only allowed to short a stock if the last price movement was positive.
Wait, really?
Yes. If a stock is already ticking downward, you cannot pile on and short it. You have to wait for it to go up before you can bet against it.
So they literally made it mathematically impossible to create sustained downward momentum. You couldn't push the rock down the hill.
Exactly. And on top of that, the margin requirements for shorting were astronomically high.
And borrowing shares was incredibly difficult.
Very difficult because the corporate cross-holding structure in Japan meant companies held onto each other's shares and refused to lend them out to short sellers.
So the pessimists are standing on the right side of the room. They see the bowling ball wobbling.
They know the price is absurd.
But when they go to place their bet, the system physically blocks them.
The data in Barsky's paper shows this with chilling clarity. The amount of short interest, the total money actively betting against the market in Japan, was a tiny microscopic fraction of what it was in the United States at the exact same time.
So what happens to that room? The room we split in half.
The right side of the room is muted. They are forced to be silent observers,
They cannot put their money where their skepticism is.
which means only the left side can speak. Only the optimists can place trades.
The market became an echo chamber.
The price of Japanese real estate and equities was no longer determined by the consensus of reality.
It was no longer a tug of war.
Because the pessimists couldn't pull their end of the rope, the price was forced upward and upward and upward.
Driven entirely by the most rabid, fanatical optimists in the entire room.
This is a massive revelation, a total paradigm shift.
Because everyone assumes a financial bubble requires the entire country to lose its mind. You assume you need 100 million people acting crazy.
The data proves you don't. You only need a small group of highly motivated, deeply convinced optimists to blow up a bubble.
Provided the system prevents the skeptics from fighting back.
The skeptics knew. They just couldn't act.
But wait,
Yeah.
I have to push back on this again, because we need to address the elite hallucination.
Right.
You're saying the skeptics knew, but who exactly were the skeptics and who were the optimists?
That's the real question.
Because the popular myth is that the retail investors, the moms and pops, the dentists, the taxi drivers, they were the foolish optimists who got swept up in the emotion.
And the Wall Street level elites, the guys in the custom suits looking at the terminals, they were the suppressed skeptics who knew it was a joke.
Right. You assume the professionals saw through the matrix. You assume the elites were the ones rolling their eyes. They are paid millions of dollars to accurately value risk. Surely they knew.
Barsky brings in survey data that completely destroys that assumption.
Ah, the survey data.
He looks at the Schiller-Kiyotaki-Tsutsui survey, the SKT survey.
Let's look at the methodology. Who exactly did they survey?
This wasn't a phone poll of average citizens. They surveyed top-tier Japanese institutional investors,
The elites.
the fund managers who were personally controlling billions of dollars of capital, pension funds, insurance giants.
And look at the timeline of the survey, the second half of 1989.
Literally the absolute peak of the madness, the jagged top of the mountain right before the cliff.
The survey asked these elites a simple question, right? Do you believe the Japanese stock market is overvalued?
What did the smartest guys in the room say?
In late 1989, over 60% of these elite institutional investors firmly answered, no, The market is not overvalued.
Over 60%.
Oh.
The overwhelming majority of the smartest financial minds in Tokyo.
They looked at land prices that had tripled. They looked at a stock market trading at a 0.5% dividend yield.
And they checked the box that said, yes, this is correct. This is the true fundamental value of these assets.
The horror of this cannot be overstated.
It really can't.
Because this means they weren't just playing a cynical game of hot potato. They weren't just riding the wave, secretly knowing it was garbage and planning to sell before the music stopped.
Some of them were playing that game, which we will dissect in a moment. But the majority, the terrifying majority of the people controlling the nation's wealth,
They actually believed the hallucination.
they internalized the illusion. Why? Because the massive growth beta of 1986 and 1987 had fundamentally rewired their brains.
They believed the old rules of economics were dead.
They believed Japan had figured out a way to grow infinitely.
So let's recap the disaster so far. The elites are actively hallucinating.
The pessimists are financially gagged by short-selling bans.
And the underlying math of the tiny numbers is a loaded spring waiting to snap.
But let's broaden the scope. Let's introduce a new character to this story.
Because Japan wasn't operating on Mars, it was operating in a global economy.
Let's bring in the cold eyes from across the ocean. The Americans.
The Americans are sitting in New York and Chicago, watching this happen. What do they see?
The SKT survey didn't just ask the Japanese. It simultaneously surveyed top-tier institutional investors in the United States.
And the data reveals a trans-Pacific divide that is absolutely staggering.
While over 60% of Japanese institutions were blindly bullish and thought prices were fair.
The survey data shows that 75% of United States institutional investors looked at Japan and said, this is completely absurd. It is a massive bubble.
75%. Three-quarters of the American elites called it exactly what it was.
They were looking at the exact same macroeconomic data, the exact same charts, the exact same dividend yields.
And they concluded it was wildly, dangerously overvalued.
So we have to pause here and ask, why? What does this mean?
Why do the insiders in Tokyo and the outsiders in New York see two completely different universes when looking at identical data?
This is a profound question about how physical proximity and cultural echo chambers affect financial reality.
The common assumption, the one you've definitely heard if you've ever watched a documentary on the 1980s, is arrogance.
The narrative always blames Japanese nationalism. It says, oh, the Japanese economy was booming. They were buying Columbia Pictures. They were buying Rockefeller Center.
It was pure arrogant chauvinism.
Right. They thought they were the master race of capitalism. So, of course, they overvalued their own stock market out of blind patriotism.
It's a very neat psychological explanation. It blames the entire bubble on a specific cultural character flaw. Hubris.
But Barsky's paper delivers another data-driven slap to that theory.
This is my favorite part of the paper. This is the moment that actually made me gasp when I read it.
The SKT surveys didn't just ask about the Japanese Nikkei index. They asked both groups of investors about their expectations for the American market.
The Dow Jones.
They asked the Japanese elites how they felt about America.
Yes, and the data unequivocally proves that Japanese investors were just as aggressively optimistic about the American Dow Jones index as they were about their own Nikkei.
Wait, so they weren't just bullish on themselves?
Not at all. They were massively, irrationally bullish on American stocks, too. Their expectations for U.S. stock returns were sky high.
So the whole arrogant nationalism theory is dead.
False. Completely false. The data murders that theory.
Here's where it gets really interesting. It wasn't Japanese exceptionalism. It was a global hallucination.
Exactly.
Yeah.
The Japanese investors were profoundly trapped in an illusion of endless worldwide high growth.
They genuinely believed that a new era of global capitalism had arrived, driven by technological advancement and central bank mastery.
And that all assets everywhere on the planet were going to skyrocket forever.
They didn't think Japan was special. They thought the future was special.
And why do the Americans see it differently? Because they weren't caught in the local Tokyo echo chamber.
Remember, the Japanese skeptics were silenced by the short-selling bans, so the social proof in Tokyo was overwhelmingly positive.
Everywhere a Japanese fund manager looked, his peers were buying. It creates a reality distortion field.
The Americans sitting in New York weren't subject to that localized reality distortion field.
They could look at the 0.5% yield, run the valuation model, see the bowling ball wobbling on the needle, and calmly say, no thanks.
That is fascinating. Distance provides clarity.
It really does.
Okay, but we have to pivot now. Because there is a very dark underbelly to the survey data that we haven't touched yet.
Yes.
We said 60% of the Japanese elites believe the market was perfectly priced, but that leaves 40%.
Yes. The minority, the ones who saw the cliff approaching.
These are the people who answered the survey and said, yes, the market is overvalued. They knew the prices were completely disconnected from fundamental reality.
Now, common sense dictates a very specific action here.
Right. If you are managing $1 billion pension fund and you know the market is a massive bubble, you sell.
All right, you liquidate your positions, take your clients' cash, and run for the safety of government bonds.
You would certainly hope so. That is what a fiduciary is supposed to do.
But let's look at what these elites actually did. This is perhaps the most chilling behavioral data point in the entire study.
Lay it on us.
Of the institutional investors who explicitly stated the market was overvalued, less than 20% actually expected the market to drop in the next year.
Let me make sure I'm hearing you correctly. They knew it was overvalued, but they didn't think it would go down.
They believed the momentum was so strong that it would defy gravity for at least another 12 months.
Wow.
And it gets worse. Nearly 40% of those exact same respondents explicitly advised their clients to stay heavily invested in the market.
Even though they knew the numbers were fake? Even though they knew the math was broken?
They knowingly, willfully rode the train toward the cliff. Why? Because they were no longer investing, they were gambling.
They were playing the greater fool theory.
The greater fool theory, in pure statistical form, it is the belief that you can buy an asset you know is worthless because you arrogantly assume you are smart enough to find a greater fool to sell it to tomorrow morning.
You think you are the smartest guy in the room. You think you can dance out the door 5 minutes before midnight, leaving the idiot holding the bag.
It is the most lethal game in finance. It's called riding the bubble.
And this behavior, this cynical, hyper-aware gambling by the elites, it creates a very specific fingerprint right before a crash, doesn't it?
It leaves a massive footprint in the data, and Barsky tracks it.
I want you to visualize another chart in your mind. This time, we aren't looking at the price of the stocks.
We are looking at the trading volume, the raw number of shares changing hands every single day.
In 1989, as we approach the absolute peak of the madness, the volume doesn't just trend up alongside the price.
No, it forms a jagged, monstrous mountain. It literally threatens to rip through the top of the chart, right before the sheer cliff edge drop.
Now, what does the average person think when they hear about massive, record-breaking trading volume on Wall Street?
The average person thinks, wow, the market is booming. Everyone is making money.
Right. It's a healthy, prosperous, hyperactive economy.
Barsky explains the mechanics of volume under this fractured reality model, and it is the exact opposite of healthy.
Break that down for us. Why is the volume exploding precisely at the peak?
Because right before a systemic collapse, you don't get calm consensus. You don't get uniform agreement that things are great. You get maximum, violent chaos.
The fracture in the trading room is widening to its absolute limit.
Think about the two groups. The optimists, the true believers in the new economy, are aggressively buying. They see the price skyrocketing, and they're terrified of missing out on infinite wealth.
They are deploying every yen they have.
But the cynics, the 40% who know it's a bubble but are trying to ride it, they are starting to panic.
They look at their watches. They realize it's 11:55 p.m. They need to find their greater fool right now.
So the cynics start aggressively selling their shares to the optimists.
Every single trade requires a disagreement. One person thinks it's going higher, one person thinks it's going lower.
The more the population disagrees about reality, the higher the trading volume goes.
Oh man, so when trading volume explodes at the peak, it isn't the sound of a healthy engine humming along.
No.
It is the death knell of a market stretched to its absolute physical limit. It is the sound of the engine tearing itself apart from the inside.
It is the physical manifestation of violently divided beliefs reaching their breaking point. The optimists are taking on maximum leverage to buy, and the cynics are desperately fleeing for the exits.
Okay, so the volume is exploding, the tension is unbearable, the bowling ball is vibrating on the tip of the needle.
And then the break, the kill shot.
What actually breaks a bubble? What makes the needle snap?
Most people, if they watch movies about Wall Street, think it's a massive wave of panic selling. You picture people running onto the trading floor, screaming, throwing their stock certificates in the air, frantically hitting the sell button.
That is the Hollywood version. The data tells a much colder, much more terrifying story.
It's not the sell-off that breaks the bubble. It's the silence.
Walk us through the mechanics of the pop. The fundamental data finally turns negative, right?
Yes. The Bank of Japan realizes things are getting out of hand. So they finally raise interest rates. The era of free money ends.
The cost of borrowing goes up, which means the expected growth rate in the math formula drops.
Yeah.
The denominator widens. The math abruptly changes.
Exactly. So the optimists, the true believers who bought everything at the peak, they finally get a dose of reality. They realize the infinite growth story is over.
They take a breath and they turn around to sell their stocks.
And who do they look for?
They look for the pessimists, the guys on the right side of the room, the skeptics who were banned from short selling earlier.
Right. The optimists say, hey, we were wrong. The price dropped 10% today. We took a haircut. You guys thought it was too expensive yesterday, but it's cheaper now. Do you want to buy it at this new lower price?
And what did the pessimists do?
The pessimists still didn't buy.
They just stared at them.
Their silence was a crushing psychological blow to the entire market.
Think about the mechanics of what happened. Because the pessimists were banned from short selling during the boom, their true, deeply negative valuation of the market was hidden. It was bottled up.
Nobody on the optimist side knew exactly how low the pessimists thought the true value actually was.
When the price dropped 10%, the optimists assumed the pessimists would step in and support the market. When the pessimists still refused to step in and buy, it revealed the horrifying truth.
This is a classic Sherlock Holmes scenario. It's the dog that didn't bark.
That is the perfect analogy. In the famous Arthur Conan Doyle story, the detective realizes the crime was committed by an insider because the guard dog didn't bark during the night. The silence was the vital clue.
In the Japanese market, the silent refusal of the skeptics to buy the dip proved that the hidden reality was far, far worse than anyone on the optimistic side had ever imagined.
The pessimists didn't just think the market was 10% overvalued. They thought it was practically worthless. They thought the true value was 50, 60, 70% lower.
And when that realization hits the optimists, when that silence echoes across the trading floor, the floor just evaporates.
Which brings us to the physics of the abyss, the shape of the crash.
Because the crash wasn't symmetrical, was it? If you look at the chart, the way down didn't look like a mirror image of the way up.
In statistics, we call this negative skewness.
Barsky's model explains exactly why bubbles burst faster than they inflate. Because all the bad news, all the deep skepticism, was artificially bottled up by the short-selling bands. The release of that pressure was catastrophic.
It's like holding a beach ball underwater. When you let go, it doesn't float up gently. It violently launches into the air. But in reverse.
Exactly. Look at the specific data points in the paper. During the entire manic boom of the late 1980s, the maximum monthly gain, the absolute best single month the stock market ever had, was 17%.
17% up in 30 days is insane growth.
But the maximum monthly drop during the bust,
What was the worst month?
a staggering 22%.
22% of the nation's wealth vaporized in 30 days.
The market takes the stairs up. But it jumps out the window on the way down.
The stairs up and the window down. Because the system intentionally hid the pessimistic truth until the mathematical pressure broke the glass.
So we are left with this smoking crater. The elites hallucinated a new reality. The cynical managers gambled their clients' money and lost. The market jumped out the window.
But I have to ask a question about the human toll here. Did anyone survive this mental virus?
Yes. And this is perhaps the final, most tragic irony of the entire Japanese bubble documented by Barsky.
Who were the sober bystanders who didn't drink the Kool-Aid?
The regular people.
Yeah.
The everyday working-class citizens of Japan.
Wait, really? Because the popular narrative is always that the whole country lost its mind.
Right. You watch the documentaries, and they show everyone buying Louis Vuitton bags, drinking Gold Flake champagne, taking taxis across Tokyo for $500. The narrative is that the average citizen was completely corrupted by greed.
That is media sensationalism. Barsky looks at the macroeconomic consumption data, and it is an absolute revelation.
He looks at the regression of log consumption on log income.
Okay, translate that for us.
If you map out exactly how much money a nation makes versus how much money they spend on goods, you get a trend line.
If the entire country actually believed they were permanently infinitely rich, if the everyday citizen internalized the new economy hallucination, that their house was going to make them a multimillionaire forever, their spending should detach from that line.
Right. If your house goes from $300K to $1 million on paper, what do people do? They take out a home equity loan, they buy a boat, they remodel the kitchen, they stop eating rice at home and go to Michelin star restaurants. Their spending floats high above their actual income.
Exactly. But they didn't do that.
The consumption data explicitly shows that Japanese consumer spending stayed remarkably flat relative to their actual income during the entire bubble period. The residual of consumption on GDP remained perfectly stable.
So the everyday citizen wasn't crazy.
Not at all. They kept working their factory jobs, they kept saving their yen, they lived within their means, they looked at the soaring land prices, and they didn't believe the hype. They implicitly knew it was paper wealth, not real wealth.
Oh, man. That is so deeply tragic.
It was a localized hallucination. The madness was contained almost entirely among the financial elite, the institutional investors, the fund managers, the guys in the custom suits in the boardrooms.
But because those elites controlled the levers of capital, because they commanded the pension funds and the corporate treasuries, they dragged the entire nation's destiny down with them into the abyss.
The regular citizens didn't throw the party. They didn't drink the champagne. But they were forced to endure the 30-year economic hangover.
Wow. Okay, let's pull all the way back. Let's synthesize this entire journey we've just been on.
We just cracked the code.
Because you realize now, after going through this data, that this wasn't a uniquely 1980s Japanese tragedy. It wasn't about sushi and neon lights and 80s hubris.
No. Barsky's paper lays out the fundamental blueprint of financial disaster. It is a mathematical and psychological machine that can be rebuilt anywhere in any decade by any culture.
Let me lay out the formula for you listening. The exact recipe for a catastrophe.
Step 1. Assign a grand, world-changing narrative to an asset. Call it a new economy. Call it a paradigm shift. And make sure the initial data, like a sudden drop in interest rates or a spike in earnings, looks flawless, giving the optimists mathematical permission to dream.
Step 2. Build a market system that either accidentally or intentionally mutes the skeptics. Ban the short sellers. Strangle the pessimists with margin rules. Create a structural echo chamber where only the most rabid optimists are allowed to set the price of reality.
And once you follow those 2 steps, it doesn't matter how great the GDP looks, it doesn't matter how smart the guys in the suits are.
The seeds of a crash are irrevocably planted. The machine will do the rest on its own.
The fragile math of tiny numbers will push prices to infinity. The cynical elites will gamble until the clock runs out. The trading volume will explode in a chaotic frenzy of disagreement.
And finally, when the narrative cracks, the silent dog will fail to bark, and the market will jump out the window.
Which brings us to the final reincarnation.
I want you to step out of 1989. I want you to come back to the present day.
It is Thursday, June 18, 2026.
Look around you, right now.
Look at the tech sector. Look at the real estate market in your city. Look at the staggering valuations of artificial intelligence companies.
This raises an important question, doesn't it?
The only thing we seem to learn from history is that we are utterly incapable of learning from history.
We look at the charts today and what do we see? We see vertical lines. We hear grand, sweeping narratives about how AI will change everything forever. We hear CEOs talking about a new economy.
The human brain still misreads the data exactly the same way it did in 1986. It still takes a temporary surge in growth, combines it with complex math, and extrapolates it out to infinity.
But the real question is about the architecture. Do our financial systems today still have blind spots?
Are the skeptics truly allowed to speak? Or are we silencing them in different, more modern ways?
We don't need a government ban on short selling to silence critics today. What about algorithmic trading that brutally squeezes anyone who bets against the momentum? What about social media echo chambers that harass and punish anyone who questions the hype? What about retail investing cults that view skepticism as treason?
The mechanics of silencing have evolved, but the result is exactly the same. The price becomes decoupled from the consensus of reality.
The wealth meat grinder will keep turning. It never stops. Because the gears aren't made of steel, they are made of human psychology and mathematical formulas.
So look at the markets you're invested in right now. Look at your 401k. Look at the house you just bought. Look at the tech stock you are holding.
Ask yourself, are the skeptics allowed to speak in that market? And more importantly, are you actively listening to them?
Or are we just repeating 1989 all over again, dressed in modern clothes?
The math is always waiting in the background. The bowling ball is always balancing on the needle.
The only question that matters is this.
When the bad news finally hits, will the dog bark or will there just be silence?